If you run a property management book of short-term rentals of any size, you've probably had some variation of this conversation more than once. A guest gets hurt. You take the call, you loop the owner in, and the owner says, "Oh, don't worry, I have insurance." A few days later, the carrier comes back and says that the claim was denied. The exclusion was buried in a policy that nobody had flagged on a property that you don't own for a decision that you weren't a part of. But your name is still in the lawsuit. That's the structural reality of property management. You operate inside decisions the owner made before you even showed up. And when those decisions go sideways, you're often the first call. This is the video where we talk about the 5 places that patterns show up most often and what you can actually do about it. As always, I'm Cody with Threshold STR. We work with hosts and property managers to identify coverage gaps before they become claims. This one is for the management side. So before we get into the 5 risks, here's the thing that's worth understanding about all of them. Property management is a business that's built on other people's decisions. The owner picked the property. The owner picked the insurance. The owner decided whether or not to put in a hot tub or a pool or a deck or a fire pit. But you manage the operation, you field the guest calls, you coordinate the maintenance, and you watch the reviews. And when something goes seriously wrong, you're often a named defendant in whatever follows, regardless of whether you had any part in the decision that actually caused it. That structural gap between operational accountability and asset ownership is where most of what we talk about today lives. Let's talk about risk 1, the owner who says that they have insurance. You've had this onboarding conversation and you ask about insurance. They tell you they have it. You move on. Then, say 8 months later, a guest slips on the exterior stairs, they hire an attorney, and the demand letter arrives addressed to both the owner and your management company. You call the owner, and the owner calls their carrier. A few days later, that carrier explains that commercial short-term rental activity was never disclosed at underwriting, and the commercial activity exclusion applies, thus the claim is denied. And here's the thing. Homeowners insurance is technically insurance in the same way a bicycle is technically transportation. It covers a personal residence used as a personal residence. But the moment a paying guest walked through the door, that policy quietly stopped covering that exact scenario everybody was counting on it to cover. And before anyone asks, the landlord policy version of this is only marginally better. Landlord policies are written for long-term tenant relationships. One tenant, a lease, a stable occupancy. A property cycling through, say, 50 guests a year is outside of those underwriting assumptions, and most landlord policies have occupancy or short-term exclusions that end up in the exact same places we're talking about right now, claim denied. And the air cover version of this is its own thing. Air cover, again, as I always say, it's a reimbursement program. It's not liability insurance, and it excludes ordinary negligence, which is the category that covers most guest injury claims. So for you, none of that matters until the lawsuit lands. And when it does, you're a named defendant, whether or not you made any of the decisions. Now let's get into risk number 2, the hot tub at midnight. There's a hot tub at a significant percentage of short-term rental properties. And there's something about hot tubs that convince otherwise functional adults that the usual rules do not apply to them. The rules about alcohol, the rules about how many people the tub is rated for, the rules about what tends to happen when you combine both midnight on a slippery deck with nobody supervising. On the other hand, hot tubs also do get bookings, and that's why they keep showing up in listings and why you keep managing properties that have them. Pools are also the same dynamic but at a higher severity. And fire pits, outdoor kitchens, docks, elevated decks with standard railing spacing, and lofted beds. They generate premium nightly rates and elevated liability exposure at the same time. And for you as the manager, that exposure layers up fast. Direct liability if you were responsible for a maintenance issue that contributed to that incident. And professional liability if you knew that the amenity wasn't properly covered and didn't address it. And imagine the reputational hit if a serious injury at one property in your portfolio ends up in the local news. Now let's talk about risk 3, the city council meeting that you didn't know was happening. Somewhere in a city council chamber right now, somebody is proposing an ordinance that's going to affect your business by next Thursday. You're not there. You don't know what's happening, but you'll find out when a client's permit renewal gets denied, or when a new registration requirement hits the city website with a 90-day compliance window, or when a neighbor files a complaint and enforcement shows up at one of your properties. Now, if you manage 30 or 40 properties in a single metro, a single regulatory change can affect a meaningful chunk of your portfolio overnight. You didn't buy the properties and you didn't accept the regulatory risk, but you're the one with the operational knowledge of which properties are affected and what the options are. So when the change comes, the work falls on you whether you're being compensated for it or not. And on the insurance side, this matters too. A property that loses its permit and keeps renting a property is where claims can be denied for that single reason alone. Risk number 4, the phone call after the storm. The storm came in and it was real. The damage was real. And the owner's insurance policy was also technically real. What turns out not to be real is the owner's assumption that their lost rental income gets calculated based on what the property actually earns on Airbnb. Standard property policies calculate loss of rents at a long-term rental equivalent rate. That number comes from comparable long-term residential rentals in the area, not from the property's actual short-term rental revenue. So let's put some example numbers on that. Say a property generates $400 a night in peak season. Then the storm hits. It's uninhabitable for 6 weeks, which is actual lost revenue is probably somewhere around, say, $17,000. If the policy calculates that loss at $1,600 a month in a long-term rental equivalent, the owner gets paid about $2,400 against a $17,000 loss. And that call that follows is the one that goes to you. The owner isn't angry at the carrier yet because they don't fully understand what just happened. They're confused, then they're frustrated, then they're looking for someone who knew how the coverage worked and didn't tell them. There's also the physical damage version. Flood damage that was never covered because the owner never bought a separate flood policy. A wind deductible that's 5% of the insured value, which the owner didn't realize that means, $20,000 out of pocket before the carrier pays anything. A screen enclosure or a dock that was never specifically scheduled on the policy also isn't covered. All prime examples that none of these decisions were yours, but they're all conversations that you're going to have to end up navigating. Risk 5. What works at 10 properties breaks at 40 properties. At 10 properties, you can keep everything in your head. You know each owner, you've had the conversation with each one, you have a general sense of what everyone has, and when something goes wrong, you have enough context to navigate it. At 40 properties, say with 40 different owners, making 40 independent insurance decisions without necessarily telling you, that informal approach is no longer a system. It's a gap. Somewhere in a 40 property book managed without a structural coverage verification process, at least one owner is going to have the wrong policy type, and at least one has had a carrier change or lapse since your onboarding that you don't know about. At least one has added a hot tub or a pool that was never disclosed to the carrier. You don't know which property, and you don't know where the gap or what the gap is. But across a portfolio of that size, the existence of at least one of those situations is really not an unrealistic assumption. The scale problem, it compounds every other risk on the list. So here's the part you're probably waiting for: the response to all of this. Now, you cannot control what the owner decides, but what you can do is set the minimum standards the management relationship requires, write them into the agreement, and verify them at onboarding as well as annually after that. Specifically, require short-term rental commercial liability coverage as a condition of management. Not homeowners, not landlords, the right policy type in writing. Require disclosure of all amenities that drive liabilities: hot tubs, pools, fire pits, docks, etc. And require that those amenities are specifically covered on the policy. Ask to be named as an additional insured on the owner's policy. This is a small request that meaningfully changes your position should something happen. Require proof of renewal every year, not a verbal confirmation, the actual certificate of insurance reviewed and filed. Now, these steps do not eliminate risk. Property management operates inside of other people's decisions. What these steps do is create a defensible operational record, surface coverage problems early enough to fix them, and shift the professional liability question in your direction when something goes wrong anyway. Now, the 3 a.m. phone call isn't going away. That's just a business. What can go away is the version of that call that includes a coverage failure that you could have caught during onboarding. If you run a book of properties and you can't say with absolute certainty which owners are specifically actually covered for short-term rental use, that's the place to start. We do portfolio coverage reviews specifically for property management companies, and it's a faster conversation before a demand letter than it is after one. You can find us at thresholdstr.com. And if you found this useful, please subscribe. We have more content specifically for property managers as well as hosts for the business coming very soon.